Yes, I was telling them it's made $2.18 so far.
Nice.
So we haven't bought
You see the
anything
name up
yet.
there, guys? Carmichael's
Yeah,
Investment
there it is.
Club at the end.
Hi, Mr. Gillis. Thanks for coming.
Hey, no problem.
We have Haley Finley
Hi, Haley.
works with Josh. Oh, she must be. Is it on? Thank you. We have Connor LaPana. He's a new one. I'll come in.
Good.
Come on, Miss. You can have a seat right by Brayden if you want. Okay, have a seat. This is Connor. He's new to the club.
What's up, Connor?
Hey, how are you?
Good.
Good.
All right. So, a couple of things we're going to talk about this morning. So we talked about doing an investment in this account of 70% equity, 30% fixed income. So it'd be $7,000 in equities. Out of that $7,000 in equities, we're going to do about $1,000 in stocks. Okay? And so part of why I wanted you guys to go ahead and reach out ahead of time is so that we could have one of these reports for some of the stocks you guys were interested in, that we could take a look at them and see what we think of them. There are a couple different ways to analyze companies and how to determine what type of company do you invest in. Now, the purpose of this account isn't necessarily to invest in stocks, but I do find that this is a good way to build knowledge and to learn about what is a good investment, what isn't a good investment. At the end of the day, each of the mutual funds or ETFs we would invest in all have stocks underneath them, right? They all build up into that mutual fund or ETF. So I'm going to talk through a couple of things and show you guys some highlights on these reports. So we're going to focus on Chipotle for the main reason that I really like Chipotle. Scott, I'm guessing you do also.
Oh yeah, me and Connor do.
All right, there you go. So we're going to talk about Chipotle. So there's two different ways to look at a stock. There's what's called technical analysis. Do you guys know what technical analysis is?
You look at the stocks high and low and based off where you're going to buy it at.
Yeah, so it's usually using charts, graphs, and such, and looking at moving averages, where has it been, where do you think it's going, that sort of thing. Or there's what's called fundamental analysis, where these reports lean themselves a bit more towards fundamental analysis. Fundamental analysis is when you're looking at how much money is a company making, how are they doing versus their peers, is the stock trading at a premium, is it trading higher than it should, or is it trading at a discount, is it undervalued, and looking at it that way. So whenever you guys think of Warren Buffett, he does fundamental investing. So he looks at what are the bones of a business, and he thinks that whenever you buy a stock, the way Warren thinks about it, he doesn't believe that you just buy a stock, but you're literally buying a business. Now, Warren has a lot more money than any of us at the table could ever dream of, but his philosophy is sound in the sense that literally whenever you buy a stock of a corporation, that is part ownership in a corporation. Okay? Now, for Chipotle, there are 1.4 billion shares right now. So that means if you buy a share of Chipotle, you have very, very little ownership in the corporation. But at the end of the day, that's what it is. So I'm going to go ahead and pull up Chipotle on the screen here, and we're going to hit some high points on here. I'll show you here in a second, Dave. And we're going to hit some high points and kind of talk through this real quick and give you guys a couple tools to look at the other stocks and see what you think of them. So right off the bat, see these stars up here? So those stars are a proprietary Morningstar system. 1 star is the worst rating it can get. 5 star is the best rating it can get. They give that rating for stocks, and there's different ratings for stocks and there's mutual funds and ETFs. But for stocks, they're trying to figure out what do we think this stock is actually worth, okay? And right now, if you look over, can you guys see the screen okay where my mouse is going? If we look over here, last close. So, as of when I pulled this report on 11/14, the day before, the stock had closed at just under $60. Morningstar's analysts are saying, hey, we think this stock is only worth $42 a share. We believe if you buy this stock today, you are paying way too much for this stock. You know, say Dave goes somewhere, gets tires on his truck, he could go somewhere and get them for $800, or the same tires in another place for $500. They're saying, hey, right now, don't buy the $800 tires. It's not worth it. Okay, so that's one of the things right off the top of the bat that I see with this. Something else here is down through here, they're giving us a view. How has this stock been trading over the past 10 years? And you can see the ups and downs of it. So this blue bar here represents the highs and lows within each month. So if there's a really long bar, that means there was a big discrepancy. So you can see in 2020, when COVID happened, the stock market dropped significantly. At the end of the year, it looks like the high was around $28.71 a share. At another point in the year, likely right around COVID, it was $8.30 a share. Now, if we look at another stock, let's look at Tesla, and you're going to see a lot of volatility in this chart. You don't have to pull it up. I'll just pull it up on the screen here. We're going to switch right back to Chipotle. So you can see Tesla has been all over the place. Share price has been climbing significantly. So it was trading for, say, $30 a share in 2019. It's done a 5-to-1 stock split and a 3-to-1 stock split, and it's up to $358 a share. So there's a lot more volatility in Tesla than there is Chipotle.
How do you determine that?
So, do you guys know what standard deviation is? It's a statistical calculation. So basically, just looking at this graph or looking at this chart, I can tell it's more volatile. Also, I know from my own analysis that I've done that Tesla is incredibly volatile, and there's a calculation you can do. Standard deviation, it will tell you that in a number. So, another thing I wanted to point out on here too, on this report, it'll show you the style box of the company. And so, do you guys remember, so there's large cap, mid cap, and then small cap, okay? And then there's also value, blend or core, and then growth, based on how it's trading. So this one is considered a large growth company, much like Apple, Microsoft, Tesla. It doesn't necessarily have to do with what type of industry it's in. It's more about what is the stock worth and what is the company worth, and taking those into account. Next, right, because we're here to make money, so how has this stock returned over the years? So total return for Chipotle year to date is up 30%. The market is only up about 25, 26%. So it's really beat the market this year. Last year, Chipotle, if you'd have bought it January 1 and held it all year, you would have made 63% back. You would have done really well. Year before that, you would have lost 21%, and you could kind of see back through here. Now, it looks like more often than not, Chipotle is pretty handedly beating the S&P 500, is what they're comparing this to. The other thing they're looking at here is how are their industry peers doing. So, and they consider industry peers like McDonald's, Starbucks, Yum Brands, any of those people. And what is the industry as a whole doing? And it looks like Chipotle is typically also outperforming the industry. So what's fascinating is, even though Morningstar is giving it a 1-star rating and saying, hey, we think this stock is trading too high, it's still producing better returns than a lot of other companies, and then the market as a whole oftentimes. There's a lot of other things on this report. We could spend a lot of time here. Basically, what's going on down through here is trying to give you financials over the years. It's trying to show you, is the company growing as years go on? Is it staying stagnant? Is it losing money as years go on? What does that look like? It's giving you some ratios over to the side here. There's a balance sheet that shows, here's the main balance sheet items. What cash does it have on hand? How much debt does it have? And then the really important one down here is price to earnings. So bottom left-hand corner is the valuation. So you can see right now, the price to earnings ratio is 55.6. The larger market is about 27. So it's about double what the market is, which is an indication of it being overvalued, right? That the stock price is trading at a much higher rate than it should be. In layman's terms, what 55 means, if you bought a share today, it would take you 55 years to recoup your investment based on today's earnings. If there is no future growth of the company, that is what that means. If there's future growth of the company, that can look totally different. That's not necessarily an indicator of 55 years.
So do you look at the current and the market? Are those the two numbers that you look at when you're comparing?
Yeah, and a lot of times you can calculate this number historically. What was it at last year, the year before that, to kind of see where's the trend of it going. Is it getting more expensive? Is it getting less expensive? Now let's look at something that's really crazy, is Tesla. So right now, Tesla is trading price to earnings ratio of 85. Its 5-year average is 378. That's saying it would take 378 years to recoup your money, because basically what was happening, Tesla was losing money. It was saying, hey, this stock is really worth nothing. It's going to take you forever and a day to get your money back, but based on future growth of the company, people still bought it because they believe that what's going to happen in the future is more important than what is happening today. And so people continue to buy, continue to buy, continue to buy it.
And that's
So-
what drives the price up, right?
Yeah, and so so somebody like Warren Buffett would say there is no chance I'm ever buying Tesla. It is not worth what people are willing to pay for it. Now, what one person is willing to pay for a painting they really like versus what another person is willing to pay for a painting they really like are two different things, right? And so some of this comes down to, and some people buy Tesla because they like Elon, and they think Elon is a genius. And they want to own a part of a company that a genius runs, is literally what it comes down to. Okay.
Especially young people. I
Yes.
think.
So what we're here to talk about, that is not a good way to invest. Okay. That is not a good long-term strategy for you guys to save for retirement, to save for a house, for anything like that. That is investing based off of emotion or what you're seeing is talked about on social media or in politics, whatever it may be. That's not a good way to do this. Part of the reason I wanted to show you guys these Morningstar reports too is to show you, hey, if you guys want to invest in stocks, and if you really want to be stock investors, you better know what these reports mean, and you better be able to read them. If you feel like you are not capable of reading these and understanding these, I would steer clear. It basically takes a master's degree in finance, in accounting, to figure out what is going on here. Even so, there are teams of thousands of people in the country, in the world, looking at these companies, doing what we're doing, but significantly deeper dive. They're getting on quarterly earnings calls, they're talking to the CEO, they're flying to plants and touring plants with people, doing all this legwork. Oftentimes, they get it wrong too, okay? If you look at, they might get it right for 1 year, for 5 years. They will not get it right for 10 years, 20 years, 30 years. That is why we do, and we suggest, one of the many reasons we suggest to do more ETFs and mutual funds, broader based, diversified investing, it is really hard to tell what is going on in a company. It's really easy to look back at Apple and say, hey, if I would have bought Apple 20 years ago, I'd have a lot of money right now. If you would have looked at Apple 20 years ago, you probably wouldn't have bought it, because you would have said, hey, this thing looks worthless. There's no way computers are going to take off like they do. What is an iPhone? What is an iPod, for that matter? What is a MacBook, right? Like, those things were not what you would have thought is going to rule the world in the future. What questions do you guys have?
So like the financial position and like the grades on the side, what do the like investor turns mean on probable analysis? What would that like?
So inventory turns.
Or inventory turns?
So that's the amount of time they turn over their inventory in a given year. So, right, they're selling burritos. So the amount of burritos, or the amount of inventory, chicken, rice, beans, cheese, whatever it is, that's the amount of times they turn it over in a given year. If you look at Boeing and you look at their inventory turns, that number is super low. They're turning over airplanes, right? They don't go through inventory a ton. There's a long lead time to get to that. The value of looking at these things over here is comparing them to their competitors and saying, hey, this is how efficient Chipotle is at doing business. How efficient is McDonald's, Starbucks? And they're not even like, it's not like whenever you're going to dinner and you say, hey, do I want Starbucks or Chipotle for dinner? That's not how investors are looking at this. Investors are looking at it and saying, hey, in the restaurant business, in this overall business, where is the best bargain had? Where is the best company to invest in? So, and that's why, like, you guys did ask for Starbucks, which could be a good one to compare it to. And so you could look at Starbucks, you could look at Chipotle side by side and say, hey, or McDonald's, whatever it may be, and say, hey, which one of these do we think would be a better investment? Now, all that to say, do you guys feel like we should be investing in Chipotle? Scott, what do you think? Tell me, why did you pick Chipotle to begin with, other than you like burritos? Or do you not like burritos?
I don't know. I kind of just picked it because it's a cheaper stock,
Mm-hmm.
so we could buy more and then maybe get more growth off of it.
Hey, so you just brought up something really good. You guys know why it's cheaper? It just did earlier this year, and I didn't know this, I was looking into this last night, a 50-to-1 stock split. Do you guys understand what a 50-to-1 stock split is?
For 50 shares you have, you get one back.
No.
Or is it?
That would be an inverse split.
Okay.
So, close. So this is, if you have one share, Chipotle then gives you 49 more shares. Say you have a piece of cake, okay? You have a piece of cake here. It's this size. You then cut it into 50 pieces. You still have the same overall piece of cake. It just is split up a lot differently. So this share price, right now it's closing at $59.91. If we do that times 50, it was trading earlier this year at $3,000 a share. One of the reasons that companies do stock splits is for that reason, as Scott just mentioned. They feel like it is really hard for retail investors to buy a share of their company if it's $3,000 a share. You have to have a whole lot of money to do that. Now, do you guys know what company Warren Buffett owns?
Coca-Cola, Apple.
Well, so what's his holding company? His overall holding company?
Starts with a B.
Berkshire Hathaway.
Yep, Berkshire Hathaway. There you go. Do you guys know what Berkshire is trading for?
Oh,
More than we can afford.
6 digits? Maybe not 6 right now.
So there's different classes of shares. So this class B is the share class that's made for retail investors like us. Okay. Now, if any of you guys have, so I'm gonna type in Class A. And so these are for people that are not like us. It is trading at $708,000 a share. One share. And there's a lot that goes into that. But it is an example of extremes to show, hey, there are a lot of different ways to do this. Could Berkshire Hathaway do a stock split, a 500 to 1 stock split? Sure. What they chose to do instead was to make a second class of shares that people could buy and leave this one intact. Why Warren decided to do that, who knows? I'm sure he's said what his reasoning is. But, yeah, so that by Chipotle doing a stock split, it now would give us the ability to buy it. If they hadn't done a split earlier this year, or we were having this conversation a year ago, it would have been out of reach. So Scott, what do you think of the stock now after we talked about it a little bit?
It doesn't seem as good, especially with the price earnings, but it could grow. You know what I mean?
Yeah, but okay, so it doesn't seem as good, but the total return year to date is 30%,
Yeah.
and the market only did 25. Last year, it did double what the market did. So whenever you're looking at historical returns, right, because here's the other thing you could get into, is you could get into the trap of only looking at historical returns and saying, hey, this is what it did in the past, this is what I think it will do in the future. Sometimes it works that way. Other times it can be dangerous. Does anybody else have any thoughts on Chipotle?
I think it's more of a risk than we would need to take, just based, but yeah, how I viewed some of the stocks and the way I'm approaching it.
So do you guys, is there another stock we want to look at that you guys sent me?
Not that I sent you, but I think that the oil field and gas field would be one of our better options as of right now.
Okay.
It's still a little low. It came off the high from everyone buying really quick right after the election, and they dropped down a good bit because people, they got up enough, they sold, just day traders. Drove it down a little bit further than it was up.
Or the question is do we even want to buy a stock in general? So one thing I'd like to do today, I would like to buy something and to start to get the account invested and making some money. Do you guys want to talk about buying a stock, or would we prefer to try to buy a mutual fund or ETF, something that is more broader based? What are you thinking?
Could we research individual stocks some more, and then maybe next month and like take a chance on that, and then maybe like just talk ETFs, mutual funds. We would love to compare like an index fund investment and a mutual fund investment if we could, or something like that. A little bit of both of those just to see how that growth works.
Yep.
But if we were all thinking we were going to be investing in individual stocks today, but maybe we do need to do a little homework and try to figure out what we want to take a chance on.
Yeah, and I think that we should invest in individual stocks for the club, right? I think up to $1,000 would be a good number to do. I was watching a video last night Warren was talking about. He said, hey, buying stocks on paper is fine, like you guys have done. Buying it with real money and losing real money is a really good opportunity to learn some lessons, okay? And I think that'll be a really good opportunity for us to learn some lessons if we choose a stock that doesn't do as well as we want it to. Now, let me ask you guys this. How are you going to figure out what is a good stock to buy? How are you going to say, hey, Josh, I think we should look at this? Or, like, how do you start looking through stuff?
Well, for me, I'm going to look at it in a technical analysis way.
Okay.
And look at it, break it down, and then ask you for a Morningstar report just to see what the returns are and the risk and the grades of the probability, financial position, and growth rate are.
Are we
That's how I'm
able
going
to
about it.
get on Morningstar ourselves? Okay.
No, it's a
How
password.
can you compare Yahoo Finance to that? If we would research it through Yahoo Finance, is it kind of close? Do they give stars? They don't.
No, Yahoo Finance doesn't. It's just purely factual. Here's what's going on. Let me do some thinking on that, because I was actually thinking about that this morning too. is what would be a good way for that to happen. Something else, has anybody ever listened to a quarterly earnings call for a company? If you guys are really interested in a stock and really want to know what's going on, look and see when the earnings call date is. And if it's not anytime soon, get on a historical, their archived earnings call. And so what it is, it's the CEO, the CFO, the chair of the board, typically an R&D guy, an operations guy, talking through this is what is happening in our company today. They answer questions from analysts, people that assign these star ratings and try to figure out what is the company worth. Those people are asking the executives, hey, we see this going on in the market. We're confused why you're doing this. Give us your reason, your explanation on that. And those earnings calls, if you really want to learn about a stock and really see what's going on, can be very instrumental in seeing the bigger landscape. And it could really convince you that this is a good investment, regardless of what the numbers say, or the other way. So one thing I'm going to suggest we do today, I don't think we're going to be in a spot to buy mutual funds or ETFs today. I'd like to spend some more time talking with you guys and comparing mutual funds, ETFs, and what good ones may look like. One of the things I usually do too is look at diversifying across the market cap weightings. So you have some large cap mutual funds, you have mid cap mutual funds, and small cap mutual funds. The companies in each of those classifications act differently. They have different returns at different levels of risk based on what's going on in the market. And it's not always very discernible on what is going to happen in the future. So what I'd like to do today is buy what's called a money market mutual fund. Has anybody ever heard of a money market account? So you can go to a
Don't
bank.
say anything deeper.
There you go. So community bank or First National, First Federal, whatever it may be, and they typically have money market accounts. And those are kind of like a savings account, except you use them a little bit less. They return a better interest rate than a checking account, similar to a savings account. What I do for clients is if they have cash in an account and they aren't ready to invest it yet, but we don't want to just leave it in cash and make $2 over a month or two. We want to make a little bit more than that. We buy what's called a money market mutual fund. It is a mutual fund that invests in short-term treasuries. It's very safe. It's not FDIC insured, but it's incredibly safe. It doesn't go up or down. It pays about 4% interest a year. And that is a good holding place to have money if you're not sure what to do with it yet. So what we're going to do is we're going to go ahead and buy. So SNOX is the ticker, SNOXX. So this is Schwab Treasury Obligations Money Fund. And we are going to purchase 10,000, nope, $10,002. And so what will be happening is, next time we talk, and I'll send a screenshot in our Google Classroom to where you guys can see the position in the account. What time does the market open? Do you guys know? 9:30. Yep. So since this is a mutual fund, this mutual fund will not purchase until tonight after the market closes at 4:30. It'll show up in the account tomorrow morning. And so tomorrow morning I'll be able to take a screenshot, send it over to you guys and say, hey, here's this. Did you hear what I was saying about the money market mutual fund?
I did, and what shocked me the most is I never ever said don't go something that's not FDIC insured. Why would you, what's the reason for that? I don't understand.
So nothing that we're investing in is FDIC insured.
Really?
Nothing.
Well, like, not even the money market.
If you were to go to a bank and open up a money market account in a bank, that is FDIC insured.
Okay.
Okay. But whenever we're talking a money market mutual fund, it is literally an investment. It is not FDIC insured. Now, right, because like I said with mutual funds, there's underlying holdings that build up to that mutual fund. So whether it's an equity mutual fund that has a bunch of stocks in it, or if it's a fixed income, in this fixed income mutual fund, it is buying 30-day U.S. Treasuries. A U.S. Treasury is considered the safest option you can buy. It is backed by the full faith of the U.S. government, which, to our current knowledge, it's believed it is incapable of going bankrupt. Now, have you guys been following what's going on with the deficit?
Yeah, there's like a huge debt.
It's massive,
Yeah.
right? And so there is concern in the finance world, is this sustainable? Is the U.S. really incapable of going bankrupt? Or could something happen, right? Part of the reason of that is because of interest rates, and interest rates have gone up so much. The U.S. has so much debt, that debt interest rate fluctuates based on the market. As interest rates have gone up, the debt payments the United States has to make is a lot bigger. So anyway, so even with all this going on, it's still considered the safest investment you can have. So even though it's not FDIC insured, we're investing in the U.S. government, which doesn't get any better than that.
Okay.
Yeah. And now, an average investor, anybody, can buy this investment. It's not just me as a financial professional. These investments, if we were doing this 5 years ago and interest rates were near zero, this wouldn't have done anything for us. It's only because interest rates are elevated right now that an investment like this makes sense. So my plan is to have this sitting there. It just be there. Whenever we meet next month, we can sell it, and it'll just be liquidated, and then we'll buy whatever we want, and we'll just use that as our holding until we find something better to put it in, right? And so that's how you kind of have to look at it is, hey, what can I find that's better to invest in than this money market mutual fund? Part of the account too is going to be in fixed income, which this money market mutual fund is considered fixed income. So we could buy a CD, we could buy a bond, we could buy a money or a mutual fund that has bonds in it. There's different ways to go there.
Okay.
I was wondering, should we have a couple people to basically come with a stock presentation for next month, or how should we go about that?
Yes, that's a great idea. So they're gonna pitch their stocks like as a team. Like how many different pitches would you like?
So overall, I would like to do 4 stock investments of $250 each.
Okay.
I think would be a fair number to get to that $1,000 of stocks. So whatever that looks like.
Okay, I'm gonna team everybody up, and then we can work it together to try to, figure out, and anyone like that's in my 9th period will be a team, and the other ones will just try to get to work together at some point in the day.
Yeah, and I don't know too how we want to go about looking at mutual funds and ETFs.
How do you
And
choose
try
that? I
to
don't
discern
really
them.
know how to guide them to choose a mutual fund.
Yeah, so we can get into that. So overall, the easiest way of looking at it, so there's what's called an index mutual fund, right? Which is you literally buy an index. So whenever I think of an index, I think of the S&P 500. And the S&P 500 is made up of, do you guys know what is in the S&P 500?
Is it the top 500 stuff?
Yep. So the top 500 US-based stocks that are publicly traded. And it buys them based on how big they are. So there's more Apple in it than there is, say, ExxonMobil, because Apple is so much bigger than ExxonMobil. And you can literally buy that and it just mirrors the market. That is oftentimes the best way to go if you're a really long-term investor, because the markets are efficient, right? And we believe that you really can't outperform the market in the long term. There's other ways to look at it. So there's a company called Barron Partners that has a lot of good funds. There are Dimensional Fund Advisors that have good funds. There's Vanguard that has mutual funds and ETFs. and this is where it's a little bit tricky because I use Morningstar a lot to analyze these. Morningstar also gives ratings to mutual funds and says, hey, we believe that this mutual fund is good because of X, Y, and Z, and I use some of that. I'm trying to think about the best way that you guys would be able to research it on your own. I'll spend some time with that and think through that.
Now, Mr. Daines has a connection at the Vanguard headquarters in Eastern PA. We're going to try to take a road trip one of these days to check that out. It'll be really fun.
Yeah. Yeah, I'm still waiting to hear back from him. We've been going back and forth a bit, but I think we might be able to make something happen to go out and meet with some folks at Vanguard. What questions do you guys have?
I don't know, but what do you think about like the stocks under $30? If we're only doing $250 per like group of stocks, we're only doing 4 stocks, and we have to get $250 for the shares. We have to stay lower just because it's like not worth buying 3 shares of stock. I think staying in the $30 or less range would be our best profit.
Could be, yeah. Yeah, certainly could be, yeah, because you're right, because you have more shares there. And that is one of the differences and one of the additional complexities. If you buy a mutual fund or ETF that has hundreds or thousands of stocks within it, you automatically get diversified amongst a very large basket of stocks with very little money, right? Whereas you're trying to buy the stocks yourselves with $1,000, there's a lot of concentration there, which can be tricky. But yeah, I agree with where you're going. I think it's a good idea. Or you could buy one stock that's $250 and that's it. But would you rather have one stock that's $250 that looks like it's a good company to buy, or take a gamble on a so-so stock that's $15? That's part of the up and down too.
But I just like, to me, it doesn't seem like there's, in our case, this is like the same money. I mean, if we buy a stock, one stock is $250, and we'd wait to get 500 to double our money.
So let me ask you guys this: if we buy a stock, how long do we plan on holding the stock? Are we going to buy it in December and sell it in January? Are we going to buy it in December and sell it after you guys graduate college? Like, what is our holding period
I
for it?
think long term. That's what I
I think long term too.
What do you guys think, everyone inside the table? Okay.
That's the view that the community foundation takes with our, endowed funds.
That's what we teach.
Long
term.
view.
Try.
Because we want to protect that corpus.
Like jumpy
you
as
know.
soon as they see it. No.
Well, yeah,
In
and
the game, we
Yes,
sell and buy,
yeah.
but in real
well,
life.
yeah, and that's why I want to have this conversation ahead of time. And I agree with what all of you guys are saying. It's yeah, buying individual stocks and having the capacity to hold on to them whenever they're losing money can be gut-wrenching at times, right? And that's not to say that mutual funds and ETFs don't lose money too. They're just not as volatile. They're not as up and down, up and down, up and down. And maybe next time we'll talk about how do we measure volatility, like how do you measure risk within an investment, and what does that look like to kind of show you, hey, this type of investment has this type of risk versus another one. Mr. Gillis, what do you think? Any thoughts?
I was just saying, like, especially when they said long term, like, because like the last time you said, is there any worry about the market? Because we're pretty close to having an executive branch that's Republican and a legislative branch that's Republican. And I know you said
Yeah,
it doesn't like that
No, it doesn't.
because it goes through too fast.
It does, and so it's going to be really fascinating. And what was super fascinating is right after the election, the market just skyrocketed. Now, since then, it's come back, and it's been closer to where it was before the election. But, yeah, it's going to be very fascinating. And some of the conversations that are being had about how to restructure government, which departments to cut, some tax changes. There's going to be a lot going on that could impact what we're looking at.
So I was gonna say, I think definitely long-term views, much better way to look at it if it's gonna get.
Yeah. And then the other question we'll have to think about too is at what point do we decide to sell a stock or a mutual fund or ETF? If we've made enough money, if it's losing a lot of money and we feel like we have a better investment for it, how do we kind of think through that? So those will be things we'll spend some time talking about as well. But I'd like you guys to do some pitches on stocks next time and to start there. I think you can wrap your arms around it a little bit more. We'll talk about mutual funds and ETFs.
So they can ask, once they determine maybe a couple, they could ask you for the report, and then they can compare again and prepare their pitch. Would that be?
Yeah, and I can also send over an analyst report that is a written narrative of what an analyst thinks about a stock and what they believe is going on in it. And I was reading a couple analyst reports last night, and they were very thorough. And I think it would give you guys some deeper knowledge into a particular stock. So I'll send over a couple things that I think would be helpful. Because this stuff is intimidating. And if you guys remember half of what we talked about today, I'll be terribly impressed. I'm sure Mr. Calvario is not going to remember half of this whenever I ask him tomorrow.
True.
Very.
They kind of, hey, I'm being honest with you. This is very intimidating to me and causes me a tremendous amount of anxiety. That's why we hire the experts, to do this. I don't have even close to the expertise that is needed. Because for us, it's not our money. It's the community. It's every donor. It's the 120 endowed funds that we have. People have given us this money. They trust us. And we trust the experts.
Yeah, and here's a realization. One of the things you guys have to take into consideration, you are responsible for investing your own money for retirement. There are very few times, the school system is one of them, where teachers have a pension. Some professions still have pensions. It is not very common. It'll be up to you, and if you ask a professional to help you figure out, how do I invest my money as I work so that when I retire, I have money to live on? And that is some of what we're getting to through these conversations, is framing it in a bigger picture and working towards that point. We are not going to find all the answers. We will likely leave this year of meeting with more answers than we started with, but hopefully that will peel back some of the false security, false knowledge that you guys feel like you have, and understand like, hey, this is a lot more complex than what it seems on the outside, and start to understand that a bit more. So it's an ongoing conversation, but please feel free, send me an email or post on the Google Classroom. Sorry, it took me a little bit to get back to Braden. I wasn't checking it for a while because nobody was posting, so I just kind of forgotten about it. And then I hopped on one day, I was like, oh, I'm a week late. But feel free, I'll be checking it more often. Hop on there, ask me questions. We'll have some dialogue back and forth. And I know our times in the mornings are pretty short.
What would you expect in a presentation, in a pitch? The history, their reason for pitching it. What other criteria do you think would go into a pitch?
I would like to walk away with the feeling that the student knows the stock and the company. Like, hey, they have spent time with this, and it is evident that they have researched it and put time into it. Each student is going to do it in their own way and in their own level of doing so. But showing that there is concentrated effort and time put into it, I think is going to be it. So it's kind of an open-ended. There's not necessarily a rubric with it. This stuff is complex. We have a short amount of time. You guys have a lot going on right now. But what I don't want to do is just buy a stock because I like burritos at Chipotle, which I certainly do like burritos at Chipotle, right? That's not a good enough reason to put $250 there. I put $250 somewhere else. Yeah, so that's the thought.
Dayton, do you want to turn that
Oh,
on?
yeah. Can you call Shoemaker now?
Yeah, I think she'll know that you're here, so you're good.
All right, does anybody else have any questions?